What's up, guys? Your boy Quick Stocks is back. It's been yet another bonkers day for our Quick Stock portfolio, with a combined total of over $5,000 in gains in our long-term portfolio. Anyways, as always, remember to hit those thumbs to recharge my dopamine, and we will get right into your quick stock analysis of Procter and Gamble. Ticker symbol P&G, trading for $119 a share as of June 8th, 2020. Equating to a $294 billion market cap and a PE, or price per earnings ratio, of 63. For transparency's sake, we already have 100 shares of Procter and Gamble, equating to a little less than $12,000, easily doubling our money if you include dividend payments. I see a lot of people sleeping on P&G, and they sure aren't getting any love here on YouTube. So let's take a deep dive and show the company some much needed hype. This is your quick stock analysis. Everyone knows how the saying goes, you get what you pay for, and in regards to Procter and Gamble, that definitely holds some truth, as Procter and Gamble has an unrivaled portfolio of brand name consumer goods packaged into a cash machine, which in turn rewards investors with a generous dividend yield of 2.67% and a $6.7 billion annual budget for share buybacks. Seriously, check this out. P&G is on a rampage. They spend around $5 billion yearly on share buybacks. You heard it here first. P&G is trying to buy back their company by removing outstanding shares from the market. I kid, but for real, this is great for long-term investors. And on top of that, the company has grown its dividend consecutively for the last 63 years, which represents a 388% increase in its 20-year annualized dividend growth. Procter & Gamble pays out nearly 70% of its earnings as dividends to investors. And on top of that, P&G has beat earnings estimates in 21 consecutive quarters. Don't get me wrong, I love tech companies and it makes up a majority of my portfolio. But seriously, P&G has been a top-tier company. But for real, not a lot of companies that we do quick stock analysis of have this kind of mentality, or even capability, to be honest. Most multi-billion dollar companies have to continuously reinvest their profits back into technology to keep one step ahead of their competitors. It really is a vicious cycle. However, when you look at Procter and Gamble, on the other hand, I'm not sure how much they actually need to reinvest into their toilet paper technology, and are able to spend a vast majority of their profit to reward investors. But anyways, we're getting sidetracked. Let's get back to your P&G quick stock analysis. The company operates through 6 segments: baby and feminine care, beauty, family care, healthcare, grooming and fabric, and home care. And within these segments, I don't think a lot of people realize how ingrained Procter & Gamble is in our lives. Procter & Gamble serves customers around the world with one of the strongest portfolios of trusted quality name brands, including Ariel, Downy, Charmin, Crest, Downy, Febreze, Gain, Gillette, Head & Shoulders, Olay, Oral-B, Pampers, Pantene, Tide, and Vicks. There's plenty more, but I think y'all get the point. Alright, y'all know I had to start this video with some hype, but let's take us back to reality. Like I said, Procter & Gamble has a price per earnings ratio of 63. Seriously, let that sink in. After all, at the end of the day, Procter & Gamble is just a household consumer product company. That's right, the makers of your toilet paper is trading for more of a premium than companies like Apple and Microsoft. Like seriously, WTF, mate. And quite simply, the reason is P&G has a devout group of investors who will buy shares at almost any price, as long as the streak of increased dividend and share buybacks remain intact. And if I'm being honest, the company is woefully overvalued. However, if they keep their dividend program intact, I honestly can only imagine them becoming more overvalued, as they continuously increase their dividend by 3 to 5% over and over, and billions of dollars of share buyback year over year. And here at Quick Stocks, we can't preach it enough, the power of compound interest. If this continues, in no time, Procter & Gamble will be paying out a 5 to 6% dividend on top of already being a top-tier company. It's seriously unheard of, and clearly it's being calculated into current share prices. And the best part is, currently the company's dividend is well covered under its free cash flow. Without going deep into the numbers, Procter & Gamble's weighted average interest rate would need to rise above 16.3% before its dividend would no longer be covered under their free cash flow. meaning investors should not be too worried about Procter and Gamble cutting their dividends at least anytime soon. But I should quickly note P&G's balance sheet really isn't squeaky clean. They actually have a total debt of $31 billion, which is actually a reduction of $34 billion in the prior year. So with all of this in mind, what's our move? Well, I'm going to be blunt. I'm definitely not going to be buying more shares of Procter and Gamble with a price per earnings ratio of 63. I'm not going to pay $63 for a single dollar of its current earnings. However, I'm also definitely not going to sell any of my shares. I'm in this for the long run. At this rate, we'll be making a 10% dividend yield. I mean, for real, that would be absolutely bonkers. But you gotta ask yourself, at what point will P&G stop compounding its dividend? And like we stated, it's unlikely they would cut dividends. But if for some reason they were to, their share price will get absolutely stomped. The thing is, Procter & Gamble is more of a hedge against our larger, much riskier investments. Because, let's be real, regardless of economic uncertainties, Procter & Gamble operates in the bare necessities. Regardless of how bad the economy is doing, people are still going to need to buy toilet paper and toothpaste. However, don't get it twisted, I'm definitely not saying the company won't have a drop in share price. When in actuality, I wouldn't be surprised to see a correction. But if the economy were to go through a rough patch, historically speaking, my investment in Procter & Gamble would be relatively sheltered, and I will continue to see a nice dividend payment. I'd also like to note we have a decent sized investment in Johnson & Johnson, who also offers a nice dividend payment, and we've seen a 200% increase from our initial position. If you guys would like to see a quick stock analysis regarding J&J, just let me know. Anyways, guys, that's all we've got for today. As always, the best investment you can make is to go long on quick stocks. Hit that subscribe button now at 358 subscribers and plan an early retirement. I'll catch you guys in the next one.